Hello everyone, it's LEYA here again, and today we are going to talk about how the market works. But it's not just theory you'll get during this video, you'll receive an awesome strategy, one that I've been using to earn a lot, consistently for a long time. You'll learn more about support and resistance levels, specifically about what forms them. You'll also learn how supply and demand move the market and get one of the most effective trading methods based on these principles. Ready to learn something new? Let's dive in! You might only know about levels from what you see on the chart. Many understand that at key levels, banks, investment companies, and other major market participants buy or sell assets in large amounts. Based on this, traders assume the future price reversals may occur at these levels. However, they often overlook a few crucial things, which is why their predictions based on supply and demand levels often fail. The first thing to note is that a level is drawn between two distinct peaks or troughs. This is a significant indication that the price may reverse from there for a third or fourth time. If you try to trade a level drawn from just one wave, you'll likely lose money because the chart often doesn't even consider such movements, as there isn't enough accumulation of positions by major participants. The second point is not to get carried away with drawing. Levels are powerful market analysis tool in skilled hands, but some people see levels where they don't exist, like on this chart. If you focus on such levels, your trading will likely suffer because not all levels within a range are as important as those as its edges. Here are examples of demand and supply levels that the price will prioritize. Drawing fewer levels will improve your trading quality because you'll stop paying attention to insignificant details. If you want to learn how to find and draw the most important and robust levels on the chart, join my Telegram channel, where you'll find lots of excellent educational content, receive high-quality support, and even have the opportunity to trade based on my signals. And now, let's move forward. The third thing I've learned during my years of trading in financial markets is that levels are zones, not lines. That is, when the price approaches a level, it won't necessarily touch it perfectly, stopping exactly at the price where it previously stopped. In other words, levels can encompass a range much larger than a line, and it's important to observe how the price behaves within such zone, not just near the line. When I talk about a zone, here's what I mean. This happens because major market players don't buy or sell at just one single price. We accumulate positions or offload them within such zones, causing the price to gradually reverse. The price may only touch the level, or it may break through it and then reverse. But if the level is strong, a reversal is inevitable, so it's essential to view support and resistance as zones, not lines. This is because the market's balance of power often shifts, and the price may move above or below a level because buyers or sellers have become slightly stronger than before, but not strong enough to continue pushing the price beyond the level. Another crucial point is the speed at which the price moved away from the level before. The less time it took for the price to sharply bounce off the level, the stronger that level is. If the candles after the bounce from the level are very large, it indicates that there were very serious volume trades. For example, based on these initial candles, you can gauge how strong the sell-offs were at the level from which the price bounced, indicating that the chart will likely behave similarly at the same price level in future. If you see such candles from the zone, the next time the quote comes from that zone, it's likely to reverse again. If the market rebounds from the zone much smoother and slower, it means that the level is likely to be broken soon. Look at this chart. Here the price rebounds very slowly from the zone, as if it's not in a hurry anywhere, and soon it returns to it again, but only to break through and plunge downwards. And the last thing I always do when trading based on the levels is look at the higher time frame. For example, I usually trade on minute charts, but even before starting work, I switch to a 5-minute chart and draw zones on it. This helps to see clear levels, but would be difficult to discern on a minute time frame. When I switch to the minute chart and observe what happens within the zone if the price has already entered it. If I see that the price is at H, it's a signal for reversal for me. Now let's move on to the strategy itself. The price is in the zone and it's about to reverse. When to enter the trade? What to look for to make the entry as accurate as possible? There are several signs I rely on, and if you are interested in them, give the video a like and subscribe. I'll be very happy to welcome new subscribers and grateful for the thumbs up. The first thing I'm interested in is whether the trend is broken. If the price stops updating its highs and lows when it enters the zone. That's exactly the case when I expect a reversal. As soon as the price breaks the trend line and slows down on the entry signals appears. The second signal is a market attempt to change the situation before the reversal. This can be seen even from one unusually strong candle that seems to want to break the level but ends there. These are the last forces that participants gather to exit the zone. But in most cases, it's not enough for a breakthrough. Moreover, before this, the price moves slowly enough, and then there is an explosion. If after such a candle there is a trend break, it's a doubly good signal for reversal. Another reinforcing signal is the second peak or bottom. This is when the price has already bounced off the zone but almost immediately returns to it and bounces again. In this case, a reversal figure of technical analysis is formed, which even the earliest traders used. It's called a double top if it forms or an uptrend, or a double bottom if it appears after a downtrend. And the last signal to enter a trade is an confirming candle. If all three signals have already occurred and after that a large candle appears that closes above the trend line, this is the decisive stage when you should enter the option. Look how it turned out in the chart. The price twice left the resistance zone before the drawing a large green candle. The highs and lows stopped updating, a double top appeared, and the trend line was broken. After the closure of this breakout candle, it's a perfect moment to enter a sell trade. In terms of time, it's enough to enter for 3 to 5 candles. As you can see, this strategy differs from those I gave you before. It's very complex, but at the same time consider it highly effective. Once you master it, you'll understand how to read the market before it reverses, catch most of these moments, and profit from them. And one more thing, don't be afraid of complexity. At first glance, it may seem that something might not work out. After you spend some time working with the chart, try to find such situations on your own in a couple of days. You'll do it freely and easily. And that's all from it for today. If you want to learn more about such strategies, be sure to join my Telegram channel via the link in the descriptions. I wish you big profits and success in everything. Bye!